Hello, everyone. Thank you for having me here. My name is Kanika, and I will be taking your session for today. But before I give a brief introduction about myself, I would like that why not start from you guys? So, any one of you would kindly like to introduce themselves?
Hello.
Hello.
Yeah, hi. Good morning, Kanika.
Good morning.
This is Subhash Roy.
Yes, hi, Subhash.
Hi. How are you?
Good, good. I am good. How are you doing?
I'm well. Actually, your picture is not clear. Here is some person is showing on nameplate.
The voice is not very clear.
Hello. Is it clear?
Hello.
Yeah. Is it clear?
Yes, it is better now.
Kanika, your voice is vibrated.
Okay, my voice is vibrating.
So please.
Is it better now?
No,
Um, okay, I think I should just exit and rejoin maybe.
not an issue. Please rejoin.
Okay. Is this the case for everybody or it's just the case for Subhash? Just if anybody of you can confirm in the chat box, please.
Yes, there is some echo in the voice.
There's echo in the voice. Okay,
Yeah.
I'll just quickly log out and just sign in again. Hi, is it better now?
No, same thing. Not a better.
I see no responses in the chat box or anywhere.
Kanika, same thing. Not changes. Voice is same.
I see that Deepak and Subhash, you've unmute yourself. Can you please confirm once if you guys can hear me?
Are we audible to you? Kanika, am I audible to you?
I think Deepak not audible, Kanika.
Yes. I think she's not able to hear us.
Yeah. Second thing, Deepak is not show the LMS pictures like showing the diagrams. Today.
Okay. Any suggestions from any one of you, like how we can correct it? Because my Wi-Fi seems to be working perfectly fine, and I don't know where is the issue.
Now it is okay.
It's not that bad. We can start.
So are we waiting for more people now? Or we can start for today?
Not an issue. You can proceed.
Okay. I'll place my mic a little away. Is it better now? Um, it's
Sure.
it's distant. Or it's still the same.
Ma'am, it's not that bad that we cannot hear. We can start, I think.
Okay, I think meanwhile I figure out how to enhance this mic and everything. Why don't any one of you start with your introductions so that we can take this forward? No, I cannot hear you. I think all of you are on mute currently.
Now it's we are
Kritika,
audible.
I cannot hear you.
Are we audible, ma'am?
We have
I think we can't.
Kanika, is our voice is audible to you?
I think it is not audible.
Can you hear each other? I mean, can anybody hear Kritika speaking? Or it's just me?
No, yes, ma'am.
Okay.
We can hear Kritika, Deepak, and others as well.
Yes, no, something.
Are we audible to you?
Yes, I can hear you.
Now your voice is now okay.
It is okay now?
Yes, yes.
Okay. Okay, so I just changed the placement, restarted the whole thing again. So I think it should be fine for now. Okay, so we've wasted a lot of time. Apologies for the delay. Um, a lot of internet use happening these days, so connectivity issues are bound to happen. I really apologize. So quickly picking up from where we left, um, let's have a quick round of introductions and then we can proceed further. Very quickly, please. Deepak, why don't you start for the class?
So what introduction
Any,
means? What are the contents you want out of that?
anything briefly about yourself, your expectations from the session, from the course, or anything which you found interesting in the past few sessions? Anything that you would like to share in this bright morning today?
Actually, we being as an engineering graduate, this course of accounting and all that is new to me.
Okay.
So I've cleared my level 1 CFA, but that experiential learning we thought that should be the part of this session. All the sessions which we are doing in this course, I FAP, what is being planned by Emarticus.
Mm-hmm. So are you finding it useful in those context, or it's way too ahead,
So,
difficult?
till now means with PMG when comes we found that, to me, my personal view is that we are delivering some bookish thought process and all that, so that those are in already in the books, so we want something experiential part of that learning.
But I think you have done only 2 sessions as of now. So
No, we have done 6 sessions
okay, you've completed 6 sessions. Okay.
from starting
Okay.
from 10th of September till now, till the last weekend.
Okay. Okay. I hope that you have a different opinion by the end of. Anybody else apart from Deepak? I see that this class is not at all participative. Why so early morning, so low on energy?
Hi, ma'am. This is Kritika.
Hi, Kritika.
Presently, I'm working in a bank,
Okay.
and as far as the sessions are concerned, yes, we are able to learn as much as we can, and the class sessions are going fine. But like Deepak said, KPMG sessions are a bit different from what we usually got to learn from Emartical's trainer. I mean
Okay.
the way they used to teach.
Okay. So you've done any other courses from Emarticus as well?
No. Actually, in the starting, Emartical's trainer took our class,
Okay.
and every week there is another person taking our class that is also breaking the flow.
So I think the idea of having a unique speaker in each of the session is to continue with the expertise level and
Yeah.
also to give you a vibe, because once you start doing it from one particular person, there is no choice of opinion left. If somebody is not able to understand a particular trainer, then there's no option left. So this is why, in order to give option to the students, the course was designed in such a manner to have unique trainers for each session.
Okay.
Okay, so let's see. We'll try to make up. I'll talk if in case you want a particular trainer or something. Maybe if we can do something about it. Yeah. Anybody else? Or we can quickly give it a pass and I see Nimesh has unmuted.
Yeah, yeah. Good morning, Nimesh this side.
Morning.
So from last 5 years, I am working with bank and having a 6 years of banking experience. The
Okay.
session is overall good, but as I am having a background of finance, so it is just it is good for me. It is a refreshing session for me. But I want, as I have joined the Matica session, I was told that it will be a more practical way of learning or anything. But that there is some bookish or the all the things are bookish, and we can search it on net and the books. So I I prefer that there some be some there must be some case studies or anything else that can give us the practical view or the practical knowledge of that theory which we are studying right now or which we have studied.
Okay. So just to answer this particular thing, we'll be giving you a case study based question towards the end of the session when all the concepts and all everything gets covered. There is for each and every batch there is a specific case study that is prepared, and that case study is quite elaborative. But only after you know certain things, you know advanced formulas in Excel. So that would be basically a more industry based, but Excel based as well. The case study, and you will have to develop your own financial model and something around it. Um, but that comes towards the end of the session. Like, I don't know, maybe I think it is the second last or um, just a session before that. But we'll be giving you case study, and that case study will get evaluated as well. So just wait for some time, and because actually and talking about the bookish language thing, the counting concepts are same across the world. Yes, we can increase the number of examples and everything for you. Apart from that, students we have who are not very well versed in accounting. This is why the course is framed in such a manner to have incorporated the bookish knowledge as well, to make people familiarize with the accounting concepts. Okay, I think that nobody else is willing to give internet. I'm working with KPMG currently. Before this, I was working with Deloitte. Um, I have an industry experience of about 4.5 years, and pretty much related to accounting advisory services, auditing services, financial transformation, modeling, mostly associated with these areas. We are currently trying to get into robotics as well. Let's see how it goes. So I'll be your trainer for today. Just a quick recap of what you did in the last class. If anybody of you can quickly pick up any topic which you liked, just to have a brush up of whatever happened in the last session. So, like to start with, like I am sure that you covered the dew point analysis in your previous session. Anything that you remember from your
Ma'am,
previous
we
sessions?
discussed about the quick ratio, cash ratios, inventory, debt, and credit collection ratios.
Okay, so basically you covered the liquidity ratios, right?
Yes, ma'am.
Okay, any other ratios apart from liquidity ratios?
We also done activity ratios
Okay,
and profitability ratios.
okay, okay. So picking up from there, I'll just quickly share my
Today we are
screen.
supposed to start solvency ratios.
Yes, I know. I just wanted you guys to just refresh. So I think you've done cash ratio.
Ma'am, we have not done cash ratio. We have done quick ratio and current ratio.
Yeah, we were left with cash ratio.
So you're done with cash ratio or you're left with cash ratio? I'm sorry, I
Left
just.
We
with
are
cash ratio,
we are
ma'am.
left with.
Okay. So this is like the third leg of. So I see Deepak has introduced themselves in the chat box.
Ma'am,
Deepak,
your screen is not visible
No,
to us.
actually, Kanika, I don't want to take much time. That's why I put down my things in chat box.
okay. See, just a brief thing I like to say before we begin. Um, you can ask me anything in between. I'll give you opportunity after every concept. You can quickly unmute yourself and we can discuss whatever comes to your mind. Just I'm trying to share my screen. When my screen is visible, please let me know. Are you able to see now?
Yes.
Yes, ma'am.
Yes, ma'am.
Aika, it can possible the brush up of the previous classes because didn't attain the.
I cannot hear you. I mean, who is speaking?
Hi, Kanika, I'm saying it can possible the brush up of the previous classes because I didn't attend the.
I'm sorry, I am not able to hear you. I don't know, your voice is extremely low. Uh, can you
Actually,
either write?
he's saying that can we brush up what we have earlier classes, what we have done it.
Yeah, sure, we can do that. We can have a quick brush up. That is how I usually start off. So just okay. So I think you guys covered liquidity ratios. It had three ratios basically: current ratio, quick ratio, and cash ratio is yet to be done. Apart from that, in the previous
Uh,
session, which
Ma'am, please
yeah,
speak loudly. Your voice, please speak loudly. Your voice is low.
okay, okay. Are you able to hear now? I hope so that you are able to hear now. Okay. Apart from this, I
Yeah,
think um, we covered. Okay, just I'll just not roll through the slides. Keep it in. Instead of me giving a brief out, I think let's do it vice versa. What we can do is to make this session a more interactive one. Um, I'll tell you the topics, and anybody of you can quickly tell me what it is. Because since these are ratios, they are simple formulas. I don't think that it should be much of a problem. So, coming to liquidity ratios, there are three types of liquidity ratios. I think you covered current ratio and quick ratio. Cash ratio is yet to be done. Anybody who can tell me quickly what is current ratio and quick ratio?
Current ratio is, ma'am, current assets plus current liabilities.
Okay. What about quick ratio?
Quick ratio is quick effects upon current liabilities.
Exactly. And the third phase is yet to be done. Then I'm sure you guys covered it in details, the benefits and the problems and everything related to it. So we'll not go into that much depth. Uh, then I think what we covered in the previous sessions were turnover ratios, and there were about 6 turnover ratios. Anybody who will name the 6 turnover ratios? I think there are 8 turnover ratios. So 8 turnover ratios, or you can just give it a try and somebody else can finish the rest.
Inventory turnover ratio,
Right.
Debtor turnover ratio,
creditor turnover
creditor,
ratio,
Data
Very
turnover,
nice.
working
creditor
capital
turnover,
turnover,
Okay.
working capital,
Fixed asset turnover
fixed
ratio.
asset turnover ratio.
Turnover ratio. Okay. So there are basically 4 turnover ratios, and 4 ratios are period based ratios. So coming to turnover ratios, there is a fixed asset turnover ratio, there is a debtor turnover ratio, creditor, and inventory turnover ratio. These are the turnover ratios. Then there are the period based ratios, which are basically the inventory conversion period, debtor collection period, creditors payment period, and lastly there is a cash cycle. So I'm sure you covered that. Um, Anybody remembers what is dew point analysis? Quickly, quickly. Um, Somebody was speaking. I don't know. The voice went away.
return duty,
Hmm. I am not able to hear you. Can anybody else hear?
it's the net profit ratio, asset turnover ratio, and equity multiplier.
Right. Okay. Fairly well. I'm glad that all of you remember a lot of concepts from previous sessions. I think apart from this, you covered asset turnover ratio, right? And asset turnover ratio in depth, like covering all the subcomponents and everything. Okay, so now coming to our session for today, we have to start with the cash ratio. Anybody who knows about cash ratio, although it's already on the screen, but anybody who previously remembers what is cash ratio, like any information you have regarding it. Hello.
so basically cash ratio, in my opinion, is that the total cash which a company's hold, or a total cash equivalents like short-term investment or the securities of the cash that can be divided by the liabilities, current liabilities.
But the point is, just this is the formula for cash ratio. You're absolutely right. But what is the purpose of
So you're having cash to pay off the liabilities, current liabilities.
And it is relevant for which all group of people. Like this information could be relevant for who all? Maybe the debtors, maybe the creditors. What comes to your mind when you think about cash ratio or the purpose behind making such a ratio?
Creditors.
Okay, very right. The creditors are always interested to know if we give the particular company some amount of loan, whether they will be able to repay it or not. This is why cash ratio becomes extremely important for them. Very nice. I don't know who this was. Actually, I've just switched off the
Parul
part of
this
the slide. Okay, very well said, Parul. So basically, the purpose of cash ratio is this only. It is the third measure of liquidity of the company. Um, in this, so everybody can see the formula on the slide. So it basically consists of mainly two things. It is the cash or the marketable securities. So marketable securities are basically readily convertible into cash. This is why they are considered equivalent as cash. So everything that is in the form of readily available cash, and then the immediate liabilities which we have to pay, not the long-term liabilities, only the current liabilities. These are the two components around which this ratio revolves. So in short, cash ratio indicates, whether the company has enough cash balance to cover the short-term liabilities of the company.
I have one question in this.
Yeah.
Many of times we have to restate the liabilities. In
Okay.
1 year, we have current liabilities. In next year, the current liabilities have been transformed into long-term liabilities, considering that period of 3 years or what, I don't know. What I came to know is that only the 3 years period is to be considered as the current liabilities, and after that it has been transformed into long-term liabilities. Again, the ratio will change, and it will give a camouflage that the cash position is denominator has been reduced, though numerator has not been increased.
Okay. Okay. Just to correct you a little, and for everybody else, you can have a situation wherein a long-term liability gets converted into a current liability in the subsequent years, but you will never have a situation wherein the current liability gets converted into a long-term liability in any of the financial statements. So the difference between current and long-term liability here is current liability is the liability which we have to repay off within a period of 12 months. That is within a period of one financial year. If on 31st March 20, we are saying that we are going to pay an X amount of liability in the coming next year, that liability will be definitely paid off within a period of 12 months, so it cannot become a long-term liability in any circumstance. Okay. There can be a situation wherein one particular liability was earlier a long-term liability. For example, you have issued debentures for a period of 3 years or bonds in Lehman. You can take an example of a bond. You've issued it for a period of 5 years. It will be a long-term liability in the first year. In the second year, till the fourth year, it will be a long-term liability. So you will not incorporate it in your cash ratio calculation. It will be incorporated in your cash ratio calculation only in the fifth year, when you know that it will get repaid within a period of 12 months. So usually what you will see is this 12 months cycle is the cycle that is relevant for the purpose of cash ratio. Is your doubt clear now? So that particular liability, since it gets repaid off in the fifth year, you will not see it in the sixth year for comparing it with anything.
So it
every
will be an
year,
off
cash
balance
ratio
sheet.
provides you a very So cash ratio basically provides you a very fresh image of the current situation of the company in that particular financial year. So there can be a circumstance, the cash ratio is maybe 4:1 in year 1 and 3:1 in year 2 and 2:1 in year 3. But all these years you will find that the cash and the marketable is it clear now?
No, my question was that if the same set of liabilities to be restated, in that case, will it be viable to see this current ratio will give a correct picture to us?
Why would you restate a liability which gets paid off within a period of 12 months?
No, restating will not be done in any of the cases. You mean to say that liabilities will not be restated? The long
Yes,
term cannot come into short term and vice versa.
no, the long-term
And
liabilities can become short-term liabilities only basis on the remaining period, how much period is left for them to be repaid. Like I explained you, for example, we've issued a bond for 5 years. It will be a long-term liability for 4 years. In the first year, since you have to repay it after 5 years, it is a long-term liability. In the second year also, the period of repayment is more than 12 months. It is a long-term liability again. Same thing goes till third and the fourth year. In the fifth year, when you assess your bond, you come to know that I have to pay this within a period of 12 months, that is within this year. So then in the fifth year, that particular bond becomes your current liability. Till the first initial 4 years, it was already a long-term liability. So there are situations wherein a particular liability is long-term liability for a couple of years. But there can never be a situation wherein a current liability gets converted into a long-term liability. Are you trying to relate with me? If you are saying in a one particular financial year,
I'll give you one case that we as a project company gets the advance from a means client and to start the project, and the project being held by the means client, and after 1 year again the liability, because there is an advance, we state as a liability to it. Again it has been, we are rolling over it to second year and we are rolling it to third year. So do we have to restate that liability as a long-term liability or what? Or we can put that rolling over endlessly?
when you do the project initially, the project is for what time span?
Means you can say that AS7 will be the accounting standard allocated to that
No.
project.
That is not my question. My question is very simple. When you've given an advance to a particular person, you expect them to complete the project in what time period?
More than
Is
a
that
year.
time period? Then it is, if it is more than a year in the first year itself, the advance is already long term, right? It is already long term, isn't it? Hello? I think we've lost.
No, yes, please.
So since in the very first year, you know that the project is not going to be completed within a period of 12 months. So in the very first year, you are very, very clear that the 12 months time period is not applicable. It is going to be more than 12 months. So it automatically becomes long term.
The advance will get adjusted in our invoices. When we'll put the invoices, it will be the client will adjust the advance and all that. So if it is more than 1 year, for example, the period of the project is 24 months, and we have got the advance and you will. Do we have to state as a long-term liability? Still, the advance can be adjusted within a year.
So firstly, I don't know if you've taken the previous sessions or not. Whenever you pay advance, for somebody to do something in return for you, it is a prepaid asset. Firstly, it is not a liability only. The
No, no,
project
no,
that
no,
is
no,
going
no,
to
no,
be
no, no, no.
delivered to you,
No, no, no.
that is going to be a liability for the company.
No, no.
You are
You have
liable.
got the advance from your client. It has to be liability.
I think, no. You first said that you have paid advance to your client and the client is
No,
supposed to deliver you the project within 1 year.
no, no. If we have to give the advance to the client, he should not be a client. We are a client to them. Okay, you can carry on.
No,
I
I
can.
think we can clear this out. Can you please explain me the whole situation? Like, I don't know if
I'm
I
saying
don't
that
know.
from
Is
the client,
anybody
we have got an advance to deliver a project in a span of 24 months, and now the project has been hold after 10 months. Do we have to restate this liability as a long term or a short term, because the cash is still with us? We have not we delivered to them as such nothing, because the project is hold from the clientele side.
okay? So again, the question arises: who is making the project? You are the ones who are making the project, right?
Yes, for them.
And for them, okay, for them, you're making the project, and you are expecting the project is not going to be finished within 12 months, or the project is finishing within 12 months. Tell me.
No, it's contractually it will be more than means I've already told that it's 24 months.
So it's 24 months. You are just receiving some advance cash from the particular client, right?
Exactly.
So
Then do
that
we
cash
have
is
to mention this is a long term or a short term liability? If the project could have been started, we could have been adjusted in a year or so. Then
so
means
firstly,
that concept that,
liability.
because recently we have
Even you
encountered
are not
this
very
question
clear with what
when
is a liability and what is an asset.
sorry.
Like, as I think that you're not very clear what is a liability and what is an asset.
Please
Firstly,
clear it, because
yes.
from my side it should be a liability, or
That
I think
money
I'm
that
not
is
able to
lying with
explain
you,
it to you the scenario.
no. The money that you have received for the project to be delivered is a liability for you because
Yes,
you have to give something in return for that money, which is the
yes,
project, right?
yes,
And if you are not utilizing that money, if you're not delivering your part of the site, which is the project, and you are delaying that project for 12 months, for 24 months, that project time period is 24 months, then it means that on the very first day, even if you have received that money, till the project is not done from your end, you will not return that money, right?
no, it will be adjusted during the
It will be
things.
adjusted during the subsequent billings, right?
Yes,
So if you're billing that particular amount within this time period, that amount got adjusted. There is nothing pending as liability in your accounts. If at the end
yes.
of 12 months you find that some balance is still remaining, you will not refund that balance to your client. That balance will still remain with you until you
In a
don't,
normal course, if the project is going smoothly, if the project is hold from their side, then do we have
then you
to
return the money.
restate this liability as a long term liability, because it is exceeding 12 months? You'll not be able to adjust those that advance
So
against
firstly,
the.
just to clarify, whenever we are preparing books of accounts, we are preparing it for 31st March in India or 31st December in USA. So the calculation whether something goes into long term or short term or current, that is done on 31st March 2000, whatever the year is. Like for this year, it will be 31st March 2020 or 2021. So this calculation is not an ongoing calculation that happens. It happens at a regular interval of 1 year. So on the 1 year, on the year end, you have to judge that, okay, these are the X amount of liabilities that are remaining with me. and what is my expectation from those liabilities, whether am I planning to pay them in the next 1 year, or am I planning to pay them in more than a year. So just talking about your situation, in the first year, you are planning to adjust that money in the time span of 2 years. So it will be a long-term liability in the first year for you till you don't adjust it. In case you adjusted it within 12 months, by the end of the first year, you will not see that liability anymore remaining in your books of accounts. So then no question of assessing it. At the end of second year, even if you find out, okay, this project is going to be finished in 1 year, in the next 1 year, then it is a current liability. If you assess that, okay, this project is still not going to finish and we are not refunding that amount as well, then it will be a long-term liability for you.
Okay, we can move forward.
I hope everybody else is clear about this and nobody is confused. Can you guys please quickly reply on the chat box?
It's clear, ma'am.
Yeah.
It is okay. It is okay.
Yeah.
Okay. So just coming back to cash ratio quickly. So I'm sure with the elaborate discussion, everybody knows the formulas and everything, a detailed discussion on the current liability and long-term liability as well. I think it is a refresher that happened. Quickly going through the problems with cash ratio. So the benefit is basically the benefit we've already covered, which is we come to know whether the companies will be able to repay back their current liabilities or not. In case a company is not able to repay the current liability, it is a not very good situation. Any investor would be a little doubtful in investing in that particular company, or we don't think very well of the company if they are not able to cover their current liabilities as well. The problems that are associated with cash ratio, as you can see, are multiple. Firstly, people, if there is very low number of cash ratio, if you don't have sufficient cash to pay back the current liabilities, it gives a very negative approach for shareholders. It just shows that they will not be able to pay back the liabilities. In case it is a very big number, suppose you have a ratio of like 5:1 or 10:1, even that is not a very favorable ratio. Why? Because then it gives an impression that, okay, this company is not utilizing their cash or resources very wisely. So you have to find for each industry there is a different level of cash ratio that is adequate for that particular industry. Once you search on Google, so you can find out based on industry that, okay, in this industry, maybe in the pharmaceutical industry, an optimum cash ratio would be 4:1, whereas in a engineering and building oriented industry, that ratio could be 2:1. So based on various industry, the optimum ratio keeps on changing. But concentrating on any one particular industry, if you have a very low number, it is also negative. If you have a very high number, then it shows that the company or the shareholders are not utilizing their cash or resources properly. Maintaining excessive level of cash is also not a very good image for any company. Coming on to the next concept, which is operating cash flow. This is basically the final measure to gauge liquidity position, which is the operating cash flow. So the operating cash flow looks only at cash coming in from operations and then divides it by current liability. So there is a very slight difference. which is in cash ratio, you have the entire cash that is involved divided by current liabilities. And in operating cash flow, you have only cash from operating activities, and then you divide it by current liabilities. So, unlike the current quick or cash ratio, where you should look only for value of at least one, the operating cash flow could be acceptable at a slightly lower amount as well, since you are considering some portion of cash only. Because other short-term assets could come into play, to cover companies' debts. Only operating cash is not required, right? So other short-term assets such as some prepaid amounts which you have, or any other form of short-term assets can also be used to repay liabilities. So this is why a slightly lesser number of operating cash flow is also fine for any industry. Is this clear now? Are we on the same page?
Can you give an example?
Can you give an example of operating cash flow? So what I'm trying to say is basically if you have, so basically there are three sources from which you can have cash. There is an operating source, there is an investing source, and there is a financing source. So when we are talking about cash ratio, we are taking into consideration all the three sources and then dividing it by current liabilities. This ratio, what I'm trying to say is this ratio needs to be at least some number which covers all the current liabilities. It cannot be a ratio which is 0.1, 0.2, 0.3 or something like that. It has to be greater than 1. At least all your current liabilities are getting covered by all the existing cash and marketable securities that you have. When we talk about the operating cash flow, then what we are trying to do is, instead of collating all the three sources of cash, you are just considering the operating cash. And what is operating cash? Basically the cash that you're obtaining from your core operations. All the cash that remains after your core activities are done. So since we are focusing only on operating cash here, even a ratio which is maybe 0.1, 0.5, which does not cover all your current liabilities, you're looking at an operating cash flow ratio. When you're looking at a cash ratio, I told you at least it should cover all your current liabilities. And why operating cash flow? We are ready to accept even a smaller number because there can be a circumstance a company has some other sources of cash which are able to cover the entire set of current liabilities remaining at the end of the year. So everybody understood the concept.
Financially.
Mm-hmm.
And how to pay long-term creditors?
How to pay long-term creditors?
Yes,
Very true. So basically, the liquidity ratios focus on the short-term creditors. You can say that whether we will be able to meet the short-term demands, and solvency ratios look at a broader picture. They cover your long-term creditors as well. So the long-term financial position they tell you, and at times you will find that yes, the liquidity ratios are importantly used, not in comparison, because each year your liquidity position can be very, very different, drastically different also. But solvency ratios are more important when you are comparing maybe two financial years or two companies. Then the role of, especially when you're comparing within one company, you want to compare the performance each and every year on year. Then solvency ratios are used much more useful because they talk about the company and then they cover the company as a whole. Even the long term aspirations are covered here. So, generally, what you can see is solvency ratios are of two types. One is oriented with debt, and one is oriented with coverage. So, debt is basically how much debt the company has, in the capital structure, and then coverage is by how much did the earning cover this particular interest and everything. Um, so, coming on to no, what So coming on to solvency ratios, so like here it is written, it focuses on the long term. Just can I just take a minute, please? There is some problem in my internet. Okay. Hi. So the solvency ratios basically focus on the long-term financial stability of the company, as you can see here. And then, so they usually comprise of, two hybrid instruments such as debt and, preferred shares, which are also known as preferential shares. So you will find the calculations going around these two things. Then I told you that, there are debt ratios and then there are coverage ratios. So debt ratios basically tell you how the company has financed itself. There are three types, maybe debt to total asset ratio, then debt to equity ratio, and debt to total capital ratio. Coming to coverage ratios, then there is what coverage ratio tell you is basically how much did the earning cover the interest cost and everything. So when you look at the formula, you find that there are two types of coverage ratio. One is the EBIT, interest coverage ratio. So this covers basically EBT plus the interest payments, and then you find, okay, whether we will be able to pay the interest payments or not. Then the other ratio around coverage ratio is the fixed charge ratio, which includes the lease payments as well. So interest coverage ratio is primarily focusing on interest coverage only, and here we are trying to focus on the installment and the interest both. So this is the slight difference between the two. In the capital structure ratio, which are basically the debt ratios, you have these broader categories. We'll be doing them in detail. Just have a glance of it in case you want to note this down. You can note this down as well. I'll give you like 2 minutes. You can note it down, and then we'll cover them. Okay, I hope that you've noted it down. We'll start with the debt equity ratio. Anybody knows about debt equity ratio? I think this is very, as the name suggests, it is the same.
The leverage.
Okay, another name is leverage. Formula for debt equity ratio?
Debt divided by equity.
What sort of a debt? Only long term, only short term?
Both.
Uh,
Total debt.
yes.
Right. You were right. What comes to your mind when you think about debt equity ratio? Like, why could it be important to know the debt equity ratio for a company? Anything that comes to your mind?
How much debt the company has as compared to the equity it has invested in.
Okay, that is what you know from the formula. But what I'm trying to ask is that what do you think? Why this information could be relevant? Why do we at all need to know that okay, this company has invested in so much amount of debt and this much amount of equity? What inference could you possibly derive from this ratio? Or
How
any
much the company is leveraged?
can you please elaborate on this, like for everybody to understand?
How much company is owing the from the banks and all that, the debt owned by them with respect to equity.
So, divide this exercise into let's try to analyze it from angles of various stakeholders. Why would the shareholders want to know this information? Debt equity ratio. What could possibly they derive from it?
Say, the safety of money, I mean, more secure funds are there in debt.
That is something that would be good for the debt holders, like the people who are providing you debt. They would definitely want to know that okay, if I am investing so much amount of money, the owner of the company, that are the equity holders, how much they have invested. Suppose in today's time, if you were going to start a business with one of your friend or with somebody random, and you approach them, okay, invest in my company, the first question that the person will ask you is, what are you going to invest in your company? Basis on that decision, any other person is going to give you a loan. Okay, I'll give you my money or place trust in your company uh, to lend you some amount of money. So for debt holders, this information is very relevant um, in order to compare that, okay, if I am lending something to a particular company, what is the trust factor that the owners have given to that particular company? Make sense? Is everybody able to catch this? Like from
Can you please
debt
repeat,
holders
ma'am?
perspective. Did you understand this example that suppose today you were starting a new business, or if you come to me to, or if I come to you that please invest in my company. I am a pharmaceutical company and I'm very new in market. I want some amount of seed money, or I want some amount of debt from you, and I'll repay it after 5 years. Would you not want to know that how much money I am investing in that company? Or you will simply give me, okay, take, you are new, so please take it.
Yes, sir. Yes, ma'am, we would definitely.
You would want to know that okay, even if I'm sharing my expertise, maybe I'm an expert doctor, I have a medical experience of about 15 years, but since I'm starting a new company, you would definitely want that I also invest something in that company. Irrespective of my expertise, you would want that if you are lending me some money, I also invest some amount of money in that company. So this is where the debt equity ratio becomes important from the perspective of a debt provider, basically. So for anybody who has given debt to the company, this ratio would be important. From equity shareholders perspective, similarly, what do you think, why would an equity holder want to know this information? Like I explained you how relevant it is for the debt holder. Similarly, if anybody can think why it will be important for the equity holder.
If there is more debt taken by the company, then it would be riskier for the equity shareholders, or the risk of getting
The
low
risk of
dividends, and
losing
if it is
debt,
more
yeah.
of debt.
Yes, you are very right on point. So for equity holders also, this is equally important. They also want to know the same information. They also want to know if we are financing the company, how much potential we have to obtain the debt. And then again, if the company becomes too much debt oriented and there is very less control of equity or very less role of equity, there is a fair chance the equity holders might lose on to their dividends, their profit shares in repaying the interest for the debt holders. So it is relevant for both the stakeholders, this debt equity ratio. And this is why this is the first solvency ratio. And now that we've covered all the
Is there any
aspects,
is there any minimum ratio for this?
no, so there is no minimum ratio. Again, this also is a ratio. So all the ratios, firstly, in I think it is only till 11th or 12th textbooks that you will find cash ratio optimum level is 2:1, debt equity ratio optimal balance is 2:1. But in nowadays scenario, if you want to do more research on this, any industry of your choice, and you will find that there are industry-wide benchmarks these days. So for different industries, different optimal levels have been decided, and those optimal levels usually don't match across different industries. So for example, if you go on Google and you can search out what is the optimum debt equity ratio for a oil company or in oil industry or in power industry, then you will be able to find and you will be able to analyze that across maybe oil companies, across power sector, across renewable energy sector, or maybe in manufacturing sector, there are slight differences in the benchmark for these ratios. Just for example, I'll just tell you, like, debt equity ratio, you cannot name one single number. You cannot say that 2:1 is an optimal ratio for all the type of industries. Imagine a situation wherein one company is a very software based company, wherein there are large softwares implemented. There is a big database. They have some cloud based accounting, so a lot of machinery is involved. Whereas another company is a very service oriented company. Maybe they are into maybe only just providing some sort of human resource facilities to clients and everything. These two industries differ too much. In the first type of industry, it would be a situation since large machinery is involved, large database servers are involved, there would be a requirement for a greater amount of equity also and a greater amount of debt also. And there can be a circumstance that the debt ratio is much more higher, and it is okay also for that industry. Why? Because it is a very capital intensive industry. Large machineries are involved and no one person can purchase such big machineries and big cloud facilities, database servers. In the second type of industry, it is a not very capital intensive industry. It is going to function well only on equity requirements. You don't require much of debt in that particular industry. So keeping both the number of debt equity ratio 2:1 for both the industry would not be right, right? It will
True.
not give a very correct image to the reader of that information. So this is something that they realized over time, and this is why you can find optimum level benchmark, but they are not 100% accurate. They are based on industry, and then also there are standard based on level of industries. So for top 10 pharmaceutical companies, you will find maybe 4:1 is the optimal debt equity ratio. But for the middle level pharmaceutical industry, 3:1 is also a good ratio. So likewise, you can research it on internet and you can find a lot of information around the ratios and various industries, what what is the optimal level. So as a homework, what you can do is any industry of your choice, you can research into it, and maybe we can have a quick discussion tomorrow regarding them. We can have a discussion around why this sort of a measure was made for that particular industry, thinking what.
This debt equity ratio, what you're saying,
Mm-hmm.
probably this is relevant for listed companies. One thing. Second thing,
Mm-hmm.
if the debt is, if a company is not owing a debt and are not listed, this ratio, is it any relevance to them or to outsider to gauge this? Because this ratio will not, this
It is good.
debt to,
It is relevant for listed companies, undoubtedly, and it is relevant for unlisted companies also. It is relevant for any company who is giving debt or who is not giving debt as well. Why it is relevant for companies who are not giving debt, I would explain. Coming to first listed and unlisted, for any person, any equity shareholder, whether listed or unlisted, they would definitely want that only not their money is invested, but some amount of money in the form of loan is also invested in the company. Why? Because it enhances the platform for the company. You have more funds in hand, and you are able to better utilize your resources. So so there has to be an optimal balance between debt and equity. No company can be purely debt based and no company can be purely equity based. Both are, I don't think that both are very feasible models. Working totally on debt is also not very correct. Working totally on equity is also not very correct, because if you invest all your funds in a particular company, then definitely you are not using your debt capacity to the fullest. Do you agree with this?
no, my question is that a company is not listed, a company is not having debt
No.
associated, and then how to go with this, how to evaluate this in solvency part?
So listed company only mean listed company does not unlisted company does not mean that they cannot take debt.
No, I'm
Today,
saying that they don't take that, they are not owing debt, as well as they don't are not listed. So you are going to tell that ratio also for those companies, so to evaluate their solvency part.
yes, you can evaluate the solvency part for any company, whether listed or unlisted. That is irrespective of listing. Listing is what listing tells you is just that
My
whether
question is not that. My question is not that. Listing or unlisting is not my scenario. Is suppose a company is not listed and
okay,
they are not owing the debt. That
a
what is
company is
the,
not listed and they don't have any debt, right?
yes.
Okay.
Then what is the means, in the what, how we are going to evaluate their solvency part?
You tell me this. What would be the solvency part in this case?
I
They
don't know.
have
That's why I'm asking a question. I'm no clue.
So you were just saying that a company is totally financed on equity, right? If they don't have any debt, means they are totally financed on equity. And if something is already financed on equity, they are solvent. But I would, this is what I was, the thing that I was explaining was financing totally on equity or financing totally on debt is just not possible in today's scenario because nobody would invest till you have invested in your own company. And financing totally on equity is a very risk averse approach wherein the company is not willing to take any sort of risk. Although they have a market standing, they can obtain debt, but still, as a matter of fact, they are not willing to obtain it. That tells they have a good solvency ratio, but that is not the optimal solvency ratio. So just going through the maths also, explaining you in mathematical terms. If you have zero debt and you have only equity, your ratio is going to be 0:1, which is okay. So you are in a no loss, no gain situation, basically. Had it been debt, maybe you have some amount of debt, 1:1 is there. Then what is happening is still you are investing one equity, but again, in the form of debt, you have received one. So your market standing becomes two in total. What looks more beneficial to you? Investing only 100 lakh of rupees yourself, or if you are investing 100 and you are obtaining debt of 100 lakhs because you are providing 100, you will have a market worth of 200, right? So 200 is always going to be better as compared to 100. Do you agree?
To the companies
So
who are
ma'am,
not
what
owing
will
the debt and they are not their thought process is not good that they should own the debt to have a good leverage and all that.
You tell me in the two circumstances which I explained you, which one looks better to you? Having only 100 crores invested in your company or working in a capital wherein you have 200 crores with you? 100 yours and 100 of debt holders. Which circumstance would you prefer?
so ma'am, I think the best example would be 50% debt and the 50% equity.
Who said this?
Manmeet.
But I think this coming. Anybody else would like to give opinion on this? 50% debt and 50% equity.
No, I disagree. Depends upon the industry and the company infrastructure also.
Yes, like I told you, totally depends upon the industry. And suppose it is a gold making industry, you don't find much of loan scenario in these ornament industry because already the stakes are very high and whatever you are investing is primary is of primary condition. So I think no business is such a business wherein if you are investing 100 lakh rupees, for example, and you will get exactly the same amount of debt. The chances of firstly getting a debt are always less than 50%. So if I am opening a company today, or even if my company is an old company and a lot of money I have invested over the years in that company, whenever you will go to obtain a loan, you will not get the same amount of loan. That loan amount will always be less as compared to what is already lying in the company. Is this correct? Is this acceptable to everybody? Like till here? Quickly in the chat box, please. if anybody is not on the same page. If today I am investing some amount of money, that same amount of money, the chances of receiving that same amount of money from debt holders are very slim. You can receive maybe 10%, 20%, 30% of that amount, but exactly 50%, firstly, you are not going to receive. Secondly, you cannot make it that 50-50 is optimal. A lot of other factors are also important while deciding this. What is your return on investment? Suppose your interest costs are very high, like extremely very high. That much you are not earning from your business, but suppose your return from your business is 16%, wherein the cost of debt is 18%. You would not want to invest too much in debt in that particular industry where the return is less than the debt charge. Getting my point? So you cannot make one single parameter that, okay, this ratio is ideal or this ratio is not ideal. In earlier times or in the traditional times, it was considered bad to take a loan. That, okay, I am going to work only on my funds and I am not going to take a loan. But today's circumstances are different. So different people can have different opinions. You will find people who are still very reluctant to invest into debt. They find it as an added cost, but the debt ratio, the debt equity ratio would be a bigger number wherein the cost of debt is low, and it would be a lesser number wherein the cost of debt is high. Like in today's circumstance, if you read out newspaper, you will find that a lot of companies are going into bond listing these days. So, okay, let's do an exercise, a very small homework for all of you, and all of you have to do this. Find any two companies who went into bond listing in India or abroad within this period of 7 to 8 months of COVID. So what you will come to know is that a lot of companies are these days going into bond listing. Why they are going into bond listing? Because the cost of debt is comparatively very low. Instead of investing their own money in the company, they are preferring to take out debt from market because the cost of debt is also very low these days because of this whole corona situation. And then they'll have a larger database to work, a larger capital base to work on.
Reliance also.
So you will find I'm sure each one of you, if you will go to internet, you will be able to find at least one example in the past 6-7 months, companies which have gone into bond listing. So this debt equity ratio is something which is based on multiple factors when you go into debt, based on industry, based on the cost of debt and the return which you are receiving on equity and the return from your particular company that you are receiving. So 50-50 वाला जो भी जिसने भी बोला, that is not correct. Different industry, different optimal level.
Second, we can say it depends upon the industry.
It depends upon the industry. All the ratios that you have studied till now, they depend on the industry. Even if somebody tells you that this 2:1 is the optimal level, that is a very wrong image because different industry can have different optimal levels and different industry will have different optimal levels, undoubtedly.
Will it depends upon the market condition of bullish or bearish?
It depends upon market condition. Like I explained you how debt equity ratio market condition has changed drastically. So if you will compare, so what you can do is just check out companies who've gone into bond listing. If you will compare their previous year financial statements and current year financial statements, you will find that till the previous year they had more of equity and less of debt in their capital structure, but after the corona times they have more of debt and less of equity in their capital structure. There can be a circumstance. because a lot of companies are these days going into the debt financing model since the interest rates are very, very low these days. So why this has happened? Because the interest rate became low because of this change of atmosphere, this corona situation, and this is why companies started to change their capital structure model, leveraging the situation. So similarly, companies tend to make these decisions on multiple factors. Sometimes company can go into debt, more of debt structure because maybe the technology is getting obsolete, so they don't want to invest their own money into that particular project and they want to invest in something else. So just to run the current operations, they are taking up more debt. So there can be multiple factors. There is no one factor which you can label as, okay, this is a deciding factor.
Hello.
Hello?
Yes, ma'am. Hello.
Hello, I can hear you.
मैम ये सॉल्वेंसी रेशियो का इंडस्ट्री में कब यूज किया जाता है?
अभी हम यूज ही समझ रहे थे इंडस्ट्री का सॉल्वेंसी रेशियो का.
नहीं, हाँ मैम, बट कब इसका यूज किया जाता है?
Anybody would like to answer this for me? Based on whatever we've discussed. Suppose like in today's time, आज का बताती हूँ. Like it is happening in today's time. So since the industry came to a standstill because of corona situation, they thought about assessing their capital structure once again. And this is why a lot of companies decided, okay, the market have changed. The cost of debt has become slightly less. If we invest in debt today, it will be a good situation for us. Because we will get debt on a cheaper note. If we'll invest our funds, then it would be expensive to us. If we have to pay an interest also, then also it is fine for us. So they revised it again. This is how, with the changing circumstances, each company, especially the big-end companies, they do this process on a regular basis because fund is an important thing to them. So for any company, they regularly evaluate, okay, this is the optimal level and this is how I can enhance or better leverage the situation. Supposedly, cost of debt becomes very, very high. Today, bank gives a notification that the interest rates have drastically increased and the lending rate would be much more higher now. Then you will find companies again changing their capital structure model. They will start repaying off their debt and focus more on equity structure. So likewise, based on changing market circumstances, each company evaluates their future and keeps on changing the capital structure. Getting my point?
Getting, ma'am.
Okay.
Clear.
So just a quick summary, everybody can see. These are basically the things that we've covered around debt equity ratio. So there's a very nice weighing balance image that is put here. 50-50. It is like you have to give equal weightage to both the concepts. You cannot be totally dependent on debt, totally dependent on equity is also not very right. You have to make in an optimal balance. So just to represent this interesting image has been put in. There are a lot of factors with of capital, then there is cost of interest also that is involved while deciding what is the optimal debt equity ratio for a company. The formula is very, very simple. It is total debt divided by equity. And this is it for the debt equity ratio. Now coming on to the next ratio, which is total debt to EBITDA ratio. So Anybody who knows the full form, I am sure that you've covered what is the full form of EBITDA? Quickly,
Earnings
maybe on
before interest, tax, depreciation, and advance.
Amortization. Amortization.
Amortization.
it is earning before you pay your interest, before you pay your taxes, before you pay your depreciation and amortization. So here what we are doing is we are subtracting cash from total debt and then dividing it by your earnings, maybe your broader earnings. Anybody who can tell me, like, what do we come to know from this ratio? Or what does it, for maybe people for whom this ratio could be relevant? Or if no idea, then
Actually, the
tell me no
balance
idea.
balance outstanding debt to the total earnings after tax uh, and
It's
interest and all
crucial
that.
for lenders, ma'am.
It is crucial for lenders, very right. Why is it crucial for lenders?
Ma'am, it will give a picture of repaying capacity.
Very well said. So firstly, it is very, very crucial for lenders. Secondly, it gives the idea of the lending capacity. How does it give idea of lending capacity? If you look at the formula, what it says is your total debt minus cash. So what will this amount tell you? That okay, after finishing all your cash, what is the debt that still remains? Okay, then whatever remaining debt is, you are dividing it by the broader earnings before giving interest, taxes, depreciation, and amortization. So all these things also have to be subtracted, but in a broader sense, you are basically considering two things. You are considering the remaining debt after using all your cash reserves, which is going to remain, and you are dividing it by your earnings, basically the broader earnings. So basis this ratio, the lender will decide, okay, if this ratio is a very big number, then the lender would come to know that the earnings are not sufficient to repay the existing debt. Why would they invest in a company, right? Which are not able to pay their current debt also with the help of their earnings. So if this number is a big number, the new lender will not give you money. If this number is a decent number and maybe a lesser number, then any debt holder would be readily willing to give that company a larger amount of debt.
The
So basically,
denominator should always be higher, on a higher side.
yes. So basically, if the numerator is a larger number, then company will not be able to get additional debt in any case. If the numerator is a smaller number, then there is a chance that the company might be able to get additional debt.
Because of the repaying capacity.
Yes. So two things what you're coming to know, how is it relevant? It is relevant for two set of people. Firstly, it is relevant for the lender. The lender comes to know that whether I can lend to a particular company or not. Secondly, it is valuable for the company also. The company also comes to know कि मुझे पैसा मिलेगा या नहीं. The company also comes to know that I would be, if I go to market today, whether people will be willing to give me debt or they will not be willing to give me debt, and accordingly, if the number is lower, the company can negotiate on the interest part that I am able to repay it, so give me debt on a lesser cost. If the number in the numerator is a higher number, the company will come to know I will not receive any debt. I will have to, if I need extra money, I will have to look out for other sources.
Ma'am, why are we considering earnings before and not the net earnings?
So we are considering, so we can do it, we can alter, we can consider it after tax also. Just as a standard practice, this is the measure that is used by the industry. Maybe first when it was created, this is how they decided to look on it. But yes, individually, just thinking about your company, you can have a different approach. You can use after tax also. Like whatever earning is remaining, you can use that ratio as well.
Because those are also the cost for the company.
Right. So here the purpose behind not using that particular cost was because depreciation and amortization is something that does not go out of our pockets in cash. And then this is why they have included it here.
Okay, ma'am.
So we've covered this, why it is important. The next ratio that is to be done is debt to capital employed ratio. So here what we are looking at is total debt divided by equity plus net debt. So looking at the formula, what comes to your mind? Like what could it signify possibly?
Ma'am, what is total debt and net debt are different?
So net debt is whatever debt is remaining after using the cash reserve.
Okay.
Yeah.
It's total debt minus cash.
Yeah. So what this, okay, I'll just quickly take through because we are short on time. So this is again another test of solvency as we know. And this ratio basically tells you what is the debt as compared to the total capital structure. Because in the denominator, you can see we have considered equity and debt. So it measures basically how much the firm's asset base is financed using debt. So it is more oriented to judge that okay, this much assets are financed using debt in my total structure.
How much
So
is the
again,
debt out of the total capital of the company?
yeah. So again, what happens, what it tells you is like how it is useful is a high ratio would indicate that there is a lot of debt that is being used in the company. So if suppose the firm's debt ratio is 0.5, this means that for every 1 rupee of debt, there are 2 asset rupees which are there, which are financed using debt. So this is a very, this is a very simple ratio. It just, tells you that, okay, this much is my total structure and this much is financed using debt. So you come to know that my company is more debt oriented or more equity oriented. And how this can be relevant, again, what I explained you, in order to decide that you want to further go for a debt situation, suppose the interest rates are changing drastically, then companies would use this ratio to judge that whether they should go in for debt or they should go in for equity, or to how much extent they should reduce the particular ratio or increase the particular ratio. Then the next ratio, then with this we finish the debt side of the ratios. Now we have the interest, the coverage ratios basically. So first one on the line is interest coverage ratio. So what interest coverage ratio does is it provides an understanding whether the company will be able to repay the interest expense or not. Okay, the formula is very, very simple. It is EBIT divided by total interest expense. What it tells you, very simple thing, whether the future interest that is applicable to a particular company, whether the company would be able to repay or it will not be able to repay. This is pretty simple. Is everybody able to hear me? I see no
Ma'am,
response.
shouldn't be total, opposite, total interest expense divided by EBIT.
So these are standard formulas that are used across industries. If you try to, you can use the vice versa version as well. But then again, for any industry, you will not be able to map it with other companies in that industry. Suppose suppose you are one hospital and the other hospital is using a standard formula. The other hospitals are going to use EBIT upon total interest, and you will be the only one who will be reversing the formula and using it. So it might not give a very comparative information in the industry. This is why these standard formulas were made. Obviously, the inference can be developed from total interest divided by EBIT also, but this is the standard they have always been using.
Okay, ma'am.
Yeah. So basically what it indicates is, suppose there is a higher interest coverage ratio, like this number is very, very high, then what it tells you is the company is there's a very less risk that you will lose onto your interest. There's a very fair chance that company will be able to pay their interest expense. Correct?
Yes, ma'am.
This is why this number was made like this, EBIT divided by total interest. So whenever you look at the number, if this number is a higher number, you come to know that, okay, my interest is safe. I will receive all the interest money that is bound to be received. If this number is a lower number, then I am at risk of not receiving my interest.
This is important for shareholders
This is
and
important for
lenders also.
lenders. Yeah.
Lenders.
The next is debt service coverage ratio. So this is the last measure to test solvency. Okay. So it is similar to basically interest coverage ratio, but instead of interest, it also covers your principal amount as well. So in this ratio, you were only you were first ensuring that, okay, my interest is getting covered or not. In the next ratio, you are also ensuring whether my principal is also getting covered or not. So it is one step ahead. So what you will find is, I'm sure all the banking guys must be familiar with this ratio, because this ratio is used a lot in banking sectors. In Indian banks, whenever you have to process loans and something, they calculate debt service coverage ratio and then they sanction some amount of loan to a company. Anybody who has seen this? I remember that there were two people in class who were from banking side. Have you come across this?
When first interest is covered, then the principal amount.
Sorry, your voice was extremely low. Can you please repeat?
When first interest is covered, then the principal amount.
Yes. First, always interest is covered and then interest, it is considered okay. Like, ठीक है, थोड़े time में when the business flourishes, they'll be able to pay the interest, the principal as well. So primary focus is on interest coverage ratio, and then there is some sort of focus on debt service coverage ratio also. But even if this number is not a very big number, it is somewhere greater than 1, then it is okay. It is considered to be fine.
Hello, ma'am.
Hello.
Hello.
Yes,
Yes, ma'am. I think debt service coverage ratio formula should be EBIT divided by interest plus interest installment on principal.
Okay, firstly, these formulas are very standard accounting formulas, like I told you repeatedly. You can alter the formula according to your own need, but that can be only according to your own need in your own business. When you have to compare it with industry, or if somebody has to compare it, they will use these standard formulas. Suppose you go to the bank and they have to, because they are the ones who are going to evaluate your debt coverage ratio, right? They will use this formula only because they have been using this formula.
EBIT divided by interest.
Yes, they will use this formula only because this is the formula that is widely used by the industry. There has to be some standard fixed, right? Today, looking at the set of information, you feel that, okay, the formula should be amended from this to this. But when they made the formulas, they considered a lot of aspects into mind, and they considered a lot of industries into mind. Like I told you, bank will not sanction loan to any one particular industry. Your formula might work in one industry, but it might not work in another industry. Suppose there is an industry wherein the taxes are very, very high. This ratio will always be a very small number. So these formulas, suppose if we were evaluating a loan in Canada, taxes are very, very high. The tax rate is, I think, almost 50%. Then this ratio would not be as same as an Indian company, right? If we consider it on the basis of EBIT.
Oh, man.
So this is why these ratios were made across the world in order to benchmark a particular position. For your own industry level decision, you can change the formulas, you can amend them a little basis on the situation. But if you want to come to a situation wherein you can compare your information with some other industry in your some other company in your industry, then you will have to use these standard formulas.
Clear, ma'am.
Okay. So I think we'll cover the rest of the topics in tomorrow's class. Let's just quickly summarize today's class. So what we can do is one by one we can just go through the topics or just.
Ma'am, solvency ratios were very new to me actually.
Okay, did you understand the relevance of each and every solvency ratio?
Yes, ma'am, I did understand, but have to go through it again.
Very good. That is good. Anybody else? If you want, I can summarize the session also. We can have a quick recap in tomorrow's class as well. If you want to go
before starting
process
tomorrow's
information
session, we can
today.
have a discussion.
Okay, I think we can summarize it for today, and tomorrow we can have a quick recap and then pursue forward. I hope that you go and revise these particular concepts and other concepts also, because we'll try and do some exercises by the end of the class, some numerical exercises in tomorrow's class. So try and revise the ratios that you've previously covered also, and then we can have some collective examples or some exercises tomorrow.
Okay, ma'am.
Okay? Okay. Have a good day. We are right on time. Thank you so much for your presence.
Thank you so much, ma'am.
Happy learning.
Thank you. Bye-bye.
Thank you. Bye-bye.